Hey there. Thanks for joining me for this recorded version of the Infinite Banking Masterclass. I am thrilled that you've decided to join me here today and that you are wanting to learn ways and strategies that are going to allow you to take back control of your money from the banks, from Wall Street, and from the financial institutions. So today we're going to talk about the infinite banking concept, how it works, how to implement it, and how to utilize it to improve your financial future. But first, like Stephen Covey says, we must begin with the why. Why would we use this strategy? What problems are we trying to solve? So we first really have to talk about the financial matrix, our financial system that for the last 80 years, it's been driven by Wall Street, the bankers, and the government. We already know that there are a few things happening right now that could potentially have very negative consequences for every American if they're not adequately prepared. If you think about what's going on with OPEC's manipulation of oil prices, or the Federal Reserve's manipulation of currency, or the big banks and fractional reserve banking, or do you think about China's economic growth, or even the fact that the US government runs $1 trillion deficits every year, and they're currently $27 trillion in debt? Now, think about the average American household there for a minute. How much of their money is tied into these global financial systems? How much are they in debt to this banking system? And how much of their cash is stored within that same banking system? How much of their retirement is invested in assets that they can't control, such as stocks, bonds, and mutual funds? What happens when taxes increase or when inflation doubles? What happens to your savings and retirement accounts when the next bubble bursts? Haven't we learned anything from the dot-com crash in 2000? Haven't we learned anything from the market meltdown in 2008? Yet most Americans keep doing the same thing over and over, hoping that it will somehow work out differently this time. Why do we keep doing those same things over and over when we already know that it's not going to work? It's because of this financial matrix. You see, the financial matrix is a system of control, financial control, where these big entities create a narrative by controlling the flow of information. And they do this in order to influence the way that you think. They want you to act in a way that will no doubt profit them much more than it's going to benefit you. Now, we've asked many questions, but these questions are difficult to answer because nobody can predict the future. But we do have strategies that you can use to insulate your savings and your investments from uncertainty and market manipulations. And that's what the infinite banking concept is all about. This easy to learn cash flow strategy will help you take back control of your capital while giving you more leverage and more liquidity throughout your working years. This is the foundational concept that I believe everyone should build their financial house upon. And ultimately, it will allow you to maximize the efficiency of your other investments while minimizing uncertainty and minimizing volatility. Now, before we move on, I want you to take notice of the graphic on the left side of your screen, that up and down yo-yo effect. That's how the stock market and other traditional investment plans move. You see, I'm going to introduce you to a new paradigm that we'll see here shortly. And as we go through the discussion today, this new paradigm is going to make a heck of a lot of sense. So, what if there was a way to protect your capital and grow it at the same time? What I am about to introduce you to is the secret strategy that the wealthiest families in America have used for generations to protect and grow their wealth. Families like the Rothschilds and the Rockefellers, they've used this strategy to create their empires. Businessmen like Walt Disney, J.C. Penney, and Ray Kroc utilize this strategy to help build their empires. But you don't need their kind of wealth to use this strategy. Now, look, what we're talking about here is maximizing our personal economy. Now, the first step to maximizing your personal economy is to maximize your income and to maximize your savings. And so, the first thing that we need to do is actually minimize, or more importantly, eliminate wealth transfers. So, to minimize or eliminate wealth transfers, you see, almost every one of us on a daily basis transfers a portion of our potential wealth away from our personal economy and out of our control forever. Some of these transfers we know about, others we have no idea that they're even happening. Now, the biggest wealth transfer that most of us are well aware of and we hate is through confiscation by the Internal Revenue Service. In other words, paying our fair share of taxes. Another wealth transfer is from interest charges on bad debt or bad spending. You see, a recent survey by GoBankingRates.com compiled a blueprint of what a typical American's spending, debt, and savings account really look like. Now, with this kind of debt, how in the hell can anyone in this country get ahead, much less have aspirations for financial freedom? And you see, the financial matrix has conditioned us that none of this matters. This is all normal. That's what they've programmed us with. It's just conventional wisdom. It's just a little bit of taxes paid over here, just a little bit of fees paid over here. It's just a little bit of interest paid over here. You see, we get accustomed to it and we don't even realize how much money is just slipping through our fingers. This is the hidden wealth transfer that the financial matrix has conditioned us to accept as normal. Now, you might not be one of those people. You may be one of those extraordinary people who pay cash for everything. Well, we'll get to you in a minute. We'll show you how paying cash is just as bad as going into debt, because paying cash is still a wealth transfer. So, a huge key to achieving financial independence is finding a way to minimize the transfer of that wealth out of your personal economy and how to recapture it back into your personal economy. Now, this starts with how you spend your money and with how you save your money. So, today, I'm hoping that I can teach you how to get a clue. That stands for control, liquidity, use, and equity. Get a clue. So the first step toward financial freedom is setting yourself up with that system that gives you more control over your money, more flexibility, more liquidity. The infinite banking concept gives you all of those things. Plus, it gives you the ability to compound your growth on earnings tax-free, plus generate tax-free retirement cash flow. It's through leverage. The infinite banking concept essentially takes $1 and turns it into two. Well, how is this possible? Well, there are really three different ways that you could use to run your household spending and investing. For the typical American that we introduced you to earlier, they are borrowing to pay for large expenses, for their lifestyle, or capital for their business. We call these people debtors. They work to spend, and since they don't have capital working for them, they can't save. Now, when expenses come up, they borrow that money and slowly repay the loan using future income. They always pay interest. The cycle of continued borrowing and repaying continues, but they are always working just to get back to zero. The debtors have obligated the majority of their future paychecks to somebody else. They have become someone else's asset. Now, the next way that we can do things, or maybe this is the traditional way that our parents and grandparents handle large expenses, is that they saved up for their money. When they have a large expense come up, what they do is they simply spend the money that they have in their savings to pay for it. Or to quote, they drain their tank. Now, as savers go through their life, they are continuously going through a cycle of filling their tank and then draining their tank. Every time they have a big expense, their tank is drained and they return back to zero. In this comparison, they are no better off than the debtor. They still wind up at zero. Each time they drain their tank, they kill their power of compounding and they have to start over. But not only do they kill their power of compounding, what they're actually doing is they're transferring their wealth to somebody else. But even worse, they are transferring the future compounding potential of that wealth to somebody else as well. Think of the lost opportunity cost. I'll show you the math on that in a bit. Now, the third way of spending and saving is to be a wealth creator. These are people who save as much of their money as possible. And then, when they need to make a large purchase, they access capital by collateralizing their wealth. The key is to borrow against an appreciating asset, thus, never interrupting compound interest. This secret, this key, is what the wealthiest families have done in America for generations. Using this strategy, you are never interrupting the compound interest on your savings. And not only are you recapturing all of the principal of a purchase by paying it back to yourself, you're also leveraging the incredible power of OPM, other people's money, and you're leveraging other people's money at effectively no cost. Well, how would that work? Well, consider this. If you are borrowing against an asset at, let's say, 4% interest, and that asset is also growing at 4% interest, guess what? You've effectively created what is called loan arbitrage. Those two figures end up canceling each other out. You're utilizing OPM at no cost. Now, you may have already kind of utilized this strategy without even realizing it. You see, if you've ever borrowed against the equity in your home by using a home equity line of credit, you have implemented this strategy. And the important thing is that I want you to remember is when you utilize this strategy, just because there's an outstanding loan against the asset, that does not affect the rate of return on that asset. For example, if the market value of homes in the area appreciate 3% that year, your home is also going to appreciate 3% as well. The growth rate isn't affected just because there's a loan out against the property. The idea here is simple. You build up equity in an infinite banking account or asset, and that asset earns uninterrupted compound interest. And then when you have a large purchase or you want to make an investment, you use the account to secure a loan to make that purchase. Now, again, I know that for most people, we have been conditioned that the word loan or debt is a four-letter word. And while those words are four-letter words, literally, I mean it figuratively. We've been conditioned that all debt is bad debt. So you might be thinking, well, if we borrow against this asset, won't it just make us a debtor? And the answer is no. You actually come out ahead, far ahead. Now, this is where the how is more important than the why. So let's get into a little math here. In fact, to go into a little more detail, even if the interest on your loan is the same as the interest on your savings, the math actually works out better. A slide or two back, I use the simple loan arbitrage concept just to kind of introduce the concept, but the math actually works out much better. Well, how can that possibly be? It has to do with the difference with the math on compounding interest versus amortized loans. Let's take a look at an example. Let's say that you can borrow $50,000 at 6% and pay it back over the course of 25 years. You'll end up paying $46,645 in interest. Now, you see, with each passing year, the principal is reduced as you make payments. So each subsequent year, as the principal is reduced, the interest calculation is reduced as well. Now, if we were to reverse the scenario and then say we had $50,000 in a savings account that was earning 6% interest over 25 years, you're actually going to end up earning $164,593 in interest. Again, because the principal increases each year due to the interest earned, each subsequent year, the interest earned is calculated on an ever-growing amount of principal. So if you want to take a look at a summary, interest earned 164,593 versus interest paid of $46,645. So a difference of $117,948. Plus, you still have the original $50,000 of principal because you never transferred that wealth away. So the final balance is $214,593. So what if you saved up and spent that $50,000? You'd be out not just that $50,000, but also the opportunity to earn all of that interest. That's why being just a saver is not necessarily the best way to build long-term wealth. Now, there are a number of different accounts that can be used to employ the infinite banking strategy. So these are capital reserve strategy accounts. First of all, we can always borrow against a savings account or a CD that you have with the bank. The second option is we can borrow against qualified retirement accounts such as 401ks, IRAs, or mutual funds. We can borrow against our stock portfolio using margin loans. We can borrow against our home equity by using a home equity line of credit. Or we can utilize permanent dividend paying life insurance. Now, when you are looking at the different ways to build cash reserves or to build equity, you have to look at 4 key characteristics. Okay. Number 1, how safe is the account or asset? Number 2, how liquid is the account or asset? Number 3, what is the typical guaranteed rate of return on the account or asset? And then how is that account or asset taxed? So we're going to unpack this and break it down a little bit here. So the first thing that we could do, we can look at savings accounts. They're generally pretty safe. They're readily liquid, but the rate of return, less than 1%. And in a way, this is a wealth transfer right here because of the opportunity cost. They're not even keeping up with the pace of inflation. And then a savings account is taxed as earned. Next up would be our qualified accounts. Is it safe? Well, in the last 20 years, we've seen 2 separate market crashes of 50% or more. How liquid is it? Well, we can't access this money before we're 59 and a half years old without penalty. We can always borrow against the account, but if employment is terminated with an outstanding loan, the employee has 30 days to repay that loan in full, or it becomes a fully taxable distribution. And then as a final kick in the groin, that distribution is subject to a 10% IRS penalty. Now, what's the rate of return? Well, seeing the yo-yo account of the market, it can be pretty dismal in the short term, but over the long term, it can ultimately be pretty good. I'm not against the stock market. I'm an investment advisor as well. But due to the yo-yo effect, that volatility in the short term, that's not the characteristic that we want for this strategy. And then taxation, it's deferred until later. Now, how about a home equity line of credit? How about that home equity line of credit? Is it safe? Can you lose equity in your home? Of course you can. The last financial crisis taught us all a very hard lesson where we always thought that real estate could only go up. And then to get a loan, it can generally take up to 30 days where you have to complete an application, get a credit check to where this loan is going to go on your credit report, job verification, income documentation, send over your tax returns. And even after all that, you can still be denied. Now, the rate of return usually pretty stable. And there are some great tax advantages to both home equity lines of credit and to owning real estate. So that brings us to option number 4, the stock portfolio. How safe is it? Well, can you lose value? How liquid is it? Now, generally speaking, stocks can be sold pretty fast. So it's pretty liquid. What is the rate of return on that account? Again, in the short term, not reliable at all. But over the long term, market trends are that the stock market usually goes up. But then how is it taxed? And, and the other thing is with the stock portfolio, if you have a loan out against the portfolio, and if the portfolio drops a certain amount, you can always get a margin call on that loan. And so that loan is then due in full immediately. So while there are many accounts that will work or could work with the infinite banking concept, there are some that work better than others. Let's talk about permanent dividend paying life insurance. Now, these companies may pay an annual dividend, and that dividend is credited to your cash account. Once that dividend is applied to your cash, it is guaranteed. You can never lose any money. From a safety standpoint, there is no better account. From a liquidity standpoint, the insurance carrier guarantees loans against that account. You use the account value as collateral for the loan, and the insurance company will loan up to 90% loan to value on these accounts. It's guaranteed, so it's highly liquid. There's no application, no credit check, no job verification, no income documentation or tax returns. You fill out a 1 or 2 page document, and the company sends you the money. Guaranteed. Now, what is the guaranteed rate of return? Well, the typical rates of return on a life insurance contract are determined by the rates of dividends credited by the carriers. Now, dividends aren't guaranteed, but they do have a guaranteed rate that won't go below a certain number. And again, the dividends that are credited are locked in. They're credited to your account, never to be lost. The rate of return on these policies have historically averaged between 4 to 6%, tax-free. Although I would be remiss without saying that in this low interest rate environment, a 3 to 5% rate of return is more reasonable, still tax-free. So when you consider the 4 criteria, safety and liquidity and a guaranteed rate of return and tax-free benefits, dividend-paying cash value life insurance satisfies all those criteria the best. Your money is safe from loss and it's guaranteed. It's completely liquid when you use the loan provision. Your money continues to grow and compound at competitive market rates. And again, if you are using the loan provision of the policy, all of the money that you're taking out is tax-free because it's a form of collateralized debt, and debt isn't taxable. So they're safer, more liquid, a better guaranteed rate of return. And then you can use the money tax-free during your working years and then turn around and use it as a tax-free pension during your retirement years. Now, the secret to using dividend-paying whole life insurance is to properly structure the contract to stuff as much cash into the contract as possible while minimizing those expenses and those charges that typically come with insurance. Now, over the lifetime of the contract, those fees and those charges and those expenses are generally going to total about 1% of the total cash value that you've accumulated. Now that we understand the basic concept, the costs, the benefits, and how they're structured, let's bring it all together. Now, this is where it gets really good. Once you've collateralized your account, you have unlimited access to spend that money tax-free or to reinvest it while still earning uninterrupted compound interest at the same time. Now, let's see what that looks like. In this example, we'll show someone who is saving $1,000 a month or $12,000 per year. And then let's say that at the end of 6 years, they've accumulated $83,704 and they want to spend that money. If they were to spend their own money, they would have to drain their tank and then start saving that $1,000 per month all over again, only to drain their tank again when they want to make another purchase and then keep repeating the cycle. The red chart shows what happens to your wealth when you interrupt compounding interest. The green chart shows what happens to the same amount of money at the same interest rates if it enjoys uninterrupted compound interest. If you were to add that $1,000 per month to your capital reserves and let it enjoy uninterrupted compound interest at the end of 30 years, if growing at 6%, it would have grown to $1 million. But by draining your tank every 6 years and interrupting the compounding power of the wealth that you're saving, this turns out to be a $1 million mistake. Now you're sold on the idea, and now you've collateralized your account. What can you do with that money? Well, this is where it gets really interesting. You can become your own bank and use that money to pay for cars, college, weddings, boats, etc. that money that the average person is transferring out of their personal economy, you're able to recapture all of that principal that you normally would lose, plus recapture the wealth potential of the future compounding interest. Plus, you are eliminating the interest due to that loan arbitrage concept that I taught you earlier. Now, here's the thing. Do we recommend that you borrow against your policy and go to Vegas? No, absolutely not. But another thing that you can do is deploy that capital into acquiring productive assets, like buying real estate, investing in a business, or even buying into the stock market after a big correction. And this is how many people have gotten wealthy. They protect and safely grow their capital, keep control and access to it, and then make a killing during downturns when everybody else is panicking and selling off assets in a fire sale. The wealthy swoop in and buy those assets for cheap. Indeed, Robert Kiyosaki from Rich Dad, Poor Dad fame, he has said on multiple occasions that the financial crash was the best time of their life because they were able to exponentially increase their wealth. But they were only able to do it because they had access to capital. Now, maybe we're not in the same position as Rich Dad, Poor Dad, but imagine being in a position where you could be sitting in the dark of your basement, greedily rubbing your hands together, just waiting for the next crash, because you know that not only will you not be hurt by it, but you'll actually be in a position to take advantage of it. Now, when would you want to get started with something like that? Before the next downturn or after? Or if you've got all of your cash rotting away in the bank, why? Isn't this a much better strategy? Now, look, Ron, okay, this is starting to sound pretty fantastic, but where's the catch? Well, there are three catches, actually. Number one, qualifying for insurance at reasonable rates, meaning you need to pass a medical exam. Being healthy is a big plus to this strategy. Now, if you aren't, don't get discouraged because there are alternative methods, but being healthy is a big plus to the strategy. Catch number two is that it does take some time. You must capitalize your policy before you can borrow against its value. Just as if you were starting a brick and mortar bank, it takes a few years to really accumulate and build capital that you can use. And then catch number three. The government limits how much you can put into these policies based on the underlying death benefit. So to maximize these policies, we must maximize the death benefit. Now, everyone is going to be different. Everyone is unique. They have a unique situation and their goals are different. And that's where working with a specialist like myself, who knows how to properly structure these infinite banking policies based on your goals, your resources, and your income, it's so important. Now, just one last thing as we come to the conclusion. Remember, the reason that we use life insurance really doesn't have anything to do with life insurance at all. It has to do with two main factors. Number one, the flexibility and guaranteed access to this line of credit that we're building through the cash value or through the equity. And then number two, how the tax code treats life insurance contracts. Indeed, CPA and famous author Ed Slott says that life insurance is the single greatest advantage in the entire United States tax code. So while the life insurance itself is a nice added benefit, if God forbid something happens to you, it's really a tertiary reason that we're using these policies. So we have the ability, along with our preferred life insurance partner companies, to create for our clients their own personal economy built upon a secure financial foundation, built upon sound economic principles. And when we do this, we're talking about long-term financial security, but we're not talking about walling off your money and letting it sit stagnant for 30 or 40 years down the road, like the typical retirement plan. And we're not talking about turning it over to somebody else and investing in somebody else's business. We're talking about developing a strategy that's going to put you back in the driver's seat by giving you control, liquidity, use of your money, and building equity. Now, the way that we strategically manage these policies, moving money in and out of them and creating velocity, utilizing the equity to acquire productive assets, this velocity gives you all the advantage. You see, we're essentially able to create more with the same dollar because we're acquiring wealth building assets, but at the same time, we're not interrupting the power of compounding on our savings. Look, there is no magic to building wealth. Wealth is created through disciplined habit of savings, uninterrupted compound interest, and the ease of leverage in the acquisition of other productive assets. The infinite banking concept, along with the use of dividend paying, cash value whole life insurance, will give you the best opportunity to compound your savings with guaranteed principal protection and guaranteed access to your capital to take advantage of investment opportunities and to maximize wealth creation. With the infinite banking concept, we're able to be flexible. We're able to take advantage of the US tax code. We're able to grow our wealth off the radar screen of the IRS for income tax purposes and create a tax-free retirement. And finally, of course, our most important promise is to secure the next generation. The infinite banking concept should be the first brick in your financial foundation that will allow you to create your own personal economy and optimize the efficiency of all of the other assets in your investment portfolio. I have never had more fun in my entire career than I am right now by educating people on how to escape the financial matrix and take back control of their money from the banking system, from the IRS, and from their complete dependence on Wall Street. Now, I'm not saying that you should put every single penny that you own into these contracts, although I do have a few clients who do, and they're happy to do so. But what I'm talking about doing is positioning you and your personal economy where you can enjoy most of your money today while still saving it for tomorrow. So now you can see that the infinite banking concept really is the best way to recapture and control the wealth that is flowing through your personal economy and still have access and control over those assets. Let's put you back in the driver's seat of your financial future. Call or message me today to schedule your free, no obligation consultation, and I'll look forward to speaking with you.